For 50 years, traders have treated one relationship as close to gospel. When the dollar rises, gold falls. When the dollar weakens, gold rallies. It was never a perfect law, but it was reliable enough to build entire hedging strategies around it. Right now, that gospel is failing the test. The dollar index is sitting near a 15-month high, and gold is holding above $4,000 an ounce at the same time. Your first instinct, when you see two assets that are supposed to move in opposite directions rising together, is probably to assume the market has gone irrational. The smarter question is not whether this makes sense. The smarter question is what force is powerful enough to override 50 years of correlation, and whether that force is temporary or structural. Stay with me, because the answer changes how you should be thinking about every position you hold in this market. As of Friday, the 24th of July, gold was trading in the range of $4,030 to $4,059 an ounce, up roughly 21% over the past 12 months. At the same moment, the US dollar index stood near 101.3, only a fraction of a point off the 15-month high it touched in late June, and up close to 4% over the past year. Brent crude pushed above $100 a barrel for the first time since May, after the United States carried out its 12th consecutive night of strikes on Iran, and the Houthis targeted Saudi oil tankers as part of a naval blockade. Money markets are now pricing in odds above 80% that the Federal Reserve delivers a rate hike at its September meeting, a remarkable shift for a central bank that spent the prior 2 years signaling cuts. Three things are true on the same trading day: a strong dollar, a strong gold price, and a Federal Reserve leaning toward tightening rather than easing. That combination should not exist under the old rulebook. So let's build the mechanism that explains why it does. Start with the part almost every headline gets right but stops short on: the war premium. The ceasefire brokered in mid-June under what's known as the Islamabad Memorandum broke down in early July, and President Trump said publicly that the truce was over. Strikes on energy infrastructure, including an attack on the Caspian Pipeline Consortium terminal, pushed Brent and WTI higher together, and higher energy prices feed directly into inflation expectations. This only makes sense once you understand the step before it, so follow the chain in order. Step 1. Conflict escalates and disrupts tanker traffic near the Strait of Hormuz, a choke point that a large share of global oil supply passes through. Step 2, oil prices rise, and rising energy costs flow into headline inflation within weeks, not months. Step 3, a Federal Reserve under new chair Kevin Warsh, already uneasy about inflation running above target, leans hawkish and lets rate hike odds climb, which is exactly what happened as September hike pricing moved above 80%. Step 4, higher expected rates should normally pull capital into the dollar and away from non-yielding assets like gold. And for a while, that is precisely what happened, pushing the dollar index toward its 15-month high. Before we get to the consequence, we need to understand the cause. And the cause here is that the same war premium lifting the dollar through rate expectations is also lifting gold through a completely different channel: pure safe haven demand. Think of it like two separate pressure systems feeding into the same weather front. One system is monetary, rate expectations pulling the dollar up. The other is geopolitical, uncertainty pulling gold up. Normally, these systems point in opposite directions, but a single shock, in this case an active war zone next to the world's most important oil corridor, can push both systems upward at once, and that is exactly what has broken the correlation this year. Here is what most coverage of this story is missing entirely. This is not simply a short-term safe haven trade that will unwind once the shooting stops. According to the World Gold Council's 2026 Central Bank Gold Reserve Survey, the largest turnout in the survey's history with 76 central banks responding, a record 45% of reserve managers say they intend to add gold over the next 12 months, and 89% expect global official holdings to keep rising. The European Central Bank's June 2026 review found that gold now makes up roughly 27% of global reserve assets against 22% for U.S. Treasuries, the first time gold has overtaken Treasuries in that measure since 1996. That is not a headline event traders reacted to for a day. That is a multi-year reallocation by the institutions that manage the largest pools of capital on Earth, and it means a meaningful share of gold demand right now is completely indifferent to what the dollar or short-term yields are doing. If you have found this level of detail useful, this is exactly the kind of analysis I put out every week, tracing the mechanism rather than just reporting the headline. Subscribing means you see the next piece of the story as it develops, rather than reading about it after the price has already moved. I read the comments on these videos, and the conversation there often shapes what I dig into next. Now, back to the analysis, because there is a distinction worth sitting with before we get to scenarios. There are two versions of you looking at a gold position right now. One version understands exactly why the position exists, can name the specific data point or event that would prove that thesis wrong, and would calmly exit if that condition were met. The other version bought because the chart was going up, has no defined thesis beyond that, and is quietly hoping the current strength continues because admitting otherwise would mean confronting a decision made on incomplete reasoning. The market does not know or care which version of you is holding the position, but your outcome over the next 6 months will depend heavily on which one you actually are. The same question applies in reverse to anyone underweight gold because the dollar looks firm on the surface. Ask yourself honestly whether your risk tolerance on paper matches the risk tolerance your actual trading behavior reveals, because the two are not always the same thing, and the gap between them is where most damage gets done. From here, 3 scenarios are realistic, and the data between now and early September will tell us which one is unfolding. Scenario 1, de-escalation, in which renewed mediation from Qatar and Pakistan produces a durable ceasefire before the Federal Reserve's September 18th meeting. Under this path, oil retreats, rate hike odds fade back toward zero, the dollar likely gives back its recent gains, and gold's war premium unwinds even as the structural central bank bid provides a floor, putting gold in a broad $3,700 to $4,100 range. Scenario 2, continued escalation without full-scale regional war, the current trajectory, in which strikes continue intermittently and oil stays elevated but does not spike further. Under this path, watch the Fed's September 18th decision itself as the confirming trigger, because an actual hike alongside persistent conflict would validate both pressure systems simultaneously, and gold could push toward $4,300 to $4,600 even with a firm dollar. Scenario 3, a genuine supply shock in which the Strait of Hormuz sees a sustained closure or a major escalation involving a third regional power. Under this path, all conventional correlations break down entirely. Oil could spike well above $120, and gold could move sharply higher regardless of what the dollar does, into territory that is difficult to bound with any precision. I'm not going to tell you which of these is most likely, because anyone who claims certainty about a live war zone is selling you confidence they do not have. Watch the September 18th Fed decision. Watch the Qatar and Pakistan mediation headlines, and let the data choose the path rather than choosing it for yourself in advance. So here's the question I actually want you to sit with, and it has nothing to do with a price target. If gold and the dollar can both rise together, breaking a relationship traders relied on for half a century, what does that tell you about how many other assumptions in your portfolio are quietly resting on correlations that no longer hold the way you think they do? Leave your answer in the comments, because that conversation is one I genuinely read and engage with. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.